screen 4. Oops. Good evening, everybody. Welcome. This is the Thursday evening Viper Trading webinar. If you are here to learn about trading the futures markets using the Viper tools, you're absolutely in the right place. First, we've got to get our standard disclaimer out of the way. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. Of course, everyone does know that you do trade at your own sole discretion. All right, we've got quite a few new people in here tonight. I don't mean to single anybody out, but for those of you that are new, and all of you for that matter, I'd like you to type in for a minute, you know, whether you have traded futures in the past, yes or no, and if you do trade futures or have traded futures, or you're looking to get back into it, what instruments you like. ES, crude oil, gold, Russell. So yes or no, have you traded futures? Yes or no? And if you have in the past or you're learning now, what instruments are you looking at? Let's pause for a minute here and get a sense from the team here what's going on here. I see a couple of no's. I take it, Minnie, that means no, you've never traded them before. A couple of ESs, some NASDAQ. Maurizio, yeah, you love the NASDAQ. I know you do. A couple of ESs and crude oil. Welcome if you're just coming in. Don't worry, we're just getting started. You haven't missed anything yet. Do I still have the disclaimer up? Let me get over to a chart. Sorry about that. Let me get over to a chart here. There we go. All right, so we got quite a mix. We got everything here from 10 years experience from James with all manner of instruments, crude oil, NASI, gold, etc. Some traders just focus on certain things like NASDAQ and YM, excuse me. And we have a few folks here that are just completely new to trading. All right, so that being said, since there are so many new people, I'm going to start off very quickly on just the basics so that when you're in the live room or when you see charts or you set up your charts or you're going to take a free trial or you're just learning this, that at least you have some modicum of knowledge about what's going on so you're not just completely in the dark. Let me start with the beginning. This is we're trading on the Ninja platform, and the software scripts that Viper Trading Systems develops run on the Ninja Trader platform. So here's a good analogy. Most of you have either like a Windows desktop or a laptop, or you have you know, a Mac or an iPhone. And so think of it this way: if you have a Windows machine and you have a Windows operating system, then you have software that runs on that operating system like Microsoft Word, Excel spreadsheets, etc., right? So think of the Ninja Trader platform as being like the Windows platform. Okay, that's the infrastructure on which everything, you know, runs basically, okay? And then you can think of the Viper scripts similar to like a Mac machine or an iPhone. Think of it as the apps. The apps run on Apple iOS, right? So you have the Apple operating system and you have the apps run on it. So it's a very similar analogy. You have Ninja Traders, the platform. You have to install that. Most of you, I think you have. If you haven't, you can download it for free at the Ninja Trader website. Go ahead and download it. You can run it for free as long as you trade in Sim. When you go to live and open a real live funded trading account, then you have to purchase a license. Most of you, some of you have taken a free trial of the Viper Trading Systems, or you're in a free trial right now, in which case Gary may have helped you install all the scripts from Viper. So here I have a chart. Let me go back here for a second. So for those of you, a couple of you are completely new, these are the instruments that we track, but there's only 4 of them that we trade in the live trading room. Most of you, of course, know what those are. Starting from the bottom here, it's YM, the mini Dow. $5 a tick. So each tick of movement is $5. We'll look at that more on a YM chart. TF, the chart I have up here, is called the mini Russell, $10 a tick. So from a risk-return perspective, one could think of it this way, that the Russell, for each equivalent tick of movement, is twice the risk and twice the gain of YM at $5 a tick. So each one is very different in how they move. And so I'm not going to beat this too much here tonight, but in many other webinars I've said this, instrument selection is very critical and key to your success. I encourage everybody to experiment when you set up your charts. Try some different instruments, put them up and experiment with them, and then try to dial in on the ones that you work with the best, that the price action speaks to you the best. All right, so that's the Russell, that's YM, the mini Dow, and then of course NASDAQ is the tech side of things. Mini NASDAQ also $5 a tick, just like YM. And the final instrument in our mix is crude oil. That's also $10 a tick. Now, crude oil is a little bit different in the fact that it is a commodity and it is not an equity. An equity is something that has a counterpart in the sort of stock world, if you will. So, for instance, ES is the E-mini S&P minis. So that obviously correlates somewhat to the S&P 500. Everybody's heard the S&P 500. This is the mini version of it, the ES contract. Now, notice that there's a date here. I'll just quickly sort of show and explain what that is and how that works. Uh-oh, hopefully I didn't mess up my chart here. Nope, crude oil. Let me go back to the Russell. Got some things I wanted to show on there before we change charts. After you install the Ninja platform, there is a way to sort of account for the different types of instruments. What you do is you go into Tools, Options, or no, I'm sorry, no, that's something else. Instrument Manager. All right, here in Instrument Manager, you can see that there is a list here of all the futures instruments. You can see that there's 172 instruments in NinjaTrader. All right, and when you click on one, let's take the Euro futures here. It shows an expiry. So here's how this works. So on the currency futures, like the ones you see here, the Aussie, British pound, Canadian, Euro, etc., these all roll on a quarterly basis. So March, June, September, December. They roll. It's kind of like, it's somewhat akin to like options. How many of you traded or have seen options? Options on stocks, options on Google, options on Apple stock. And if you've traded or you've seen options, you know that they have an expiration where you've got to get in or out of those options or roll them to another month. So futures are somewhat similar to that in the fact that they have an expiration. So every quarter on the currency futures and the equities, they roll, and you have to go to the current front month. Now the best way I want everybody to bookmark this, if you're going to trade futures, you've got to know about this website. It is called cmegroup.com. Let me get out of this here. Everybody gets the idea on that. Let me just show you very quickly what this site is. For those of you who are experienced traders, please bear with me. I'm trying to get everybody up to speed at the same level here, so we don't have folks who are trying to figure out what the heck I'm talking about half the time. At least be able to see some trades. So very quickly, everybody knows CME Group. This is the site. Now what you can do is you scroll down here very quickly, and in the middle of the page you can see all the different instruments on the exchange, and you can mouse over it and it will tell you the current front month of each contract. So if you're ever wondering, should I be in June, should I be in May, should I be in July, what's the current front month, cmegroup.com, come down into here and it'll tell you exactly what they are for everything. There's gold over here, energy, of course you see this is crude oil. Crude's still in May, see that, May. All right, okay. The other thing that we all need to be aware of, and I think most of you are, is we use the Forex Factory website for our news. You want to bookmark these. CME Group and Forex Factory are two sites that are used very frequently. Forex Factory every day, as a matter of fact. The site looks like this. You want to set up your, if you're only going to trade US dollar related instruments, you would just simply toggle on USD for your news events, apply the filter, and you want to set your time clock to correspond with your current time. You can do that here. Click on it. So let's look at tomorrow. What's up for tomorrow news? Well, let's take a look. I'm here in California. So you can see here it gives you different gradations of how important the news is. So for instance, in the pre-market session at 5:30, you have a medium impact manufacturing index number. Capacity utilization is 15 minutes before the equity markets open at 6:30 a.m. Pacific. And then you have at 7 a.m. a high impact consumer sentiment number. Now, why is it important to know these news events? Here's why. Particularly when you have high impact events, is depending on the results of how the news comes in relative to the expectations, it can have a dramatic effect on the equity markets and crude. It pushes markets around. You have to be prepared. So at 7 o'clock tomorrow, we're going to prepare ourselves for these consumer sentiment numbers. In other words, you might want to tighten your stops, tighten your targets, get out of certain positions, allow the market to react to the news, move, and then we'll take action based on that movement. Okay? All right, so that's Forex Factory, that's the CME Group, Ninja Platform, Instruments. Any questions on that? All right, I don't see anything. Good. So let's get into the heart of the matter here, which is the actual trading itself. Now I'm going to start here again. I'm going to build sort of a foundation at a very basic level, and then we're going to add layers on top of it so that we all understand how we approach markets. All financial markets, it doesn't really matter what it is. It could be Forex, futures, stock markets, have different types of price patterns throughout the course of a trading session, or in the case of the futures, trades around the clock, right? And they go through periods of what I would call sideways, range-bound, or consolidative type price action. So for instance on here, let me put the yellow one up here. I think it's going to be better. Let me put the yellow horizontal line. Put one like this. I'm going to give you just some rules of thumb, and I'm going to show just some very, very basic things here first, and then we'll talk about how we deal with it. So what I'm doing here, and there's Gary, my partner, business partner Gary, as you probably know, he's fanatical about putting lines on charts. You see lines on charts in the live trading room. I trade with lines on the charts. I make sure that I always have some kind of support and resistance lines on my charts at all times, because if you notice this chart, before I put the lines on there, looked like a bunch of squiggles, didn't it? I mean, some of you might have been able to sort of visually see that it was chopping in these ranges, but the fact of the matter, you put the lines on there, it really puts a frame of reference around the different levels where it's really, you know, bouncing and hitting resistance. Everybody see that? Now there's two types of range-bound consolidation. There's two types. There is what I would call to be, let's start with the easiest one first. I would call tight consolidative range at or near the mid-band, or some a location at a different band. Let me show you some examples of that right here. Here's a good example right here. See how these bars are kind of just shotgunning around the middle band? Oh, let me back up for a second. I kind of skipped over this step, so let me just take 2 steps back real quick. All right. What you see on the chart here in terms of the Viper indicators, where we come into play, if you took all the things off of here, you would essentially just have a bar chart, right? Just a bar chart, which is very difficult to trade, because visually it just looks like, in real time, just a bunch of bars kind of going all over the place, right? So what we did is we came in and we wrote scripts that put the colors of see these background colors, the bar colors, red, yellow, and blue, and of course the swing levels. We have the predictor, which is also swing levels, and of course the most prominent thing on this chart from a visual standpoint is the middle band. We call the mid band. You hear that in the room all the time, right? I'm looking for it to pull back to the mid band, consolidate for a trade setup. Yes, you hear that all morning long. And then we have 1, 2, 3, 4 bands above it, 1, 2, 3, 4 bands below it. Those are the bands. And so we use these scripts to frame the context of what's going on in the market and to make decisions. Now let me contrast this view very quickly. Let me go back here. This is the Russell from today. So here's the close of the market is over here. So here's real time. This is where the Russell is at right now. 11:25:40. It's right here. This is really where it's at. Okay. Right. And here we go. Let's go back. Let me contrast that area that you just looked at with something that looks more like this on the left. Okay, so let me ask a question. Let me pause, make sure everybody's still awake and listening to what I'm saying here. What is the difference between something that looks like this on the right and something that looks like this on the left here? What's the difference between this type of price action right here? And by the way, this you're going to notice my webinars are a little bit different than maybe some others. I'm a highly interactive person. That's the way I've always traded and taught and what have you ever since we started Viper all those years ago. To highly interact. I'd like to make my webinars very interactive. I think people get a lot more of it when you interact, ask lots of questions, make sure everybody's participating. So what I'm saying is that to the extent that you participate in the webinar and join in the questions and what have you, it's going to help you learn quicker. You're going to pick it up much faster. So here again, so what is the difference between this chart that looks like this and a chart that looks more like this? This is, by the way, this particular topic is probably the single most important thing. I mean, there's lots of important things you have to learn in trading. You know, many things you have to sort of keep in mind when you trade. But this topic right here is sort of the core foundation of it all. I see quite a few answers coming in here. Gene says the one on the left is trending up. Trending versus chop, says Stefan. Up and then sideways. Volatility. Trending versus sideways. Jim W. Good. Gene, one is ranging and the other one isn't. Perfect. All right. So if you're going to trade any markets, any time of day, day or night, it doesn't matter what the market is. Literally, it doesn't really matter because they all go through the same cycles. Is at any given point, if you're going to trade that particular market you're looking at, you have to know, am I trending? And if you are trending, what direction is the trend? Is the trend up or down, right? Because that drives all your decision making in regards to trade entry. Or am I range bound, consolidating in a sideways type price action like you see right here? And that's where the lines come into play. The reason I say the lines are so critical and why it comes into play is because the lines not only show where support and resistance are, but I think we all would agree that after you drew these three lines right here, and you actually knew these lines back over here. This was midnight the other day. This is midnight today, right? I'm here in California. It's all Pacific time. Midnight Pacific was right here, right? Midnight Pacific was right here. So this is the European session. You're going into the European session, and if you drew a line up here, if you drew a line in the middle and you drew a line down here, you knew these levels as before 1 o'clock a.m. Pacific time, yes? So Mindy, just at a very basic level, here's the best way to think of it and the easiest, simplest way for anybody to look at this. I want you to take the current swing level, and a swing level is defined where a market comes up and reverses. So here's a swing right here. So you're going to take an upper swing level like that, and you're going to take your horizontal line tool and you're going to put a line right there. Okay? Now, if you have an intermediate swing level, like in the middle, somewhere around the midband, you can also put a line right in here. And then you want to find the lowest swing level. So down here you can see that the market came down and checked this level, found support, bounced, and came up close to the upper level. So now we have 3 lines right here. So the premise is this. It's really super simple. As long as the market stays within the confines of these 3 lines, you are said to be going sideways or range bound. Now, I want to be clear about this. You can't take these lines because of the fluidity of live moving markets, chisel them into granite and say, well, you know, excuse me, pardon me, hold on a second, 1 second, please. We can't be rigid in the way that we view these lines because they're just guideposts. In other words, there are going to be areas where a market comes down slightly below a line, right? There's going to be some areas where a market's going to go slightly above a line. Let me ask you a second question, make sure so everybody's still awake and with me here. When a market pokes up through a swing like this, is this a trend change? Do you have a trend here now? See how this spiked up? Do we have an uptrend now with this spike? Came up, held a midband here. I think we might be heading up here. Is this spike through the line? Came out of the range. So we're in an uptrend here, right? See the green background? It's technically a higher high and a higher low, yes? Right here. Are we now in an uptrend right here at this circle? So that is speaking directly to the whole issue of range bound versus trending. Okay, Diane, Michael P, Dennis, some veterans weighing in. No, it's not. So let's be clear about how we can tell the difference. One spike up does not a trend make. Now, if these markets had gone something like this, where you get this notion of what's called the thrust move in what could possibly turn out to be an uptrending direction, the critical components of telling whether you have a trend or not is where it pulls back to and finds support in the case of an uptrend, yes? And then where it follows through to. So in order for this to be a bona fide uptrend, it would have to pull back at some support level like it did right there, and then go up like this and take that swing level out. Now that's the 3 components of a trending move. Up for a trending up move, back down, up through the swing to higher swings, and then the pattern repeats itself. A, B, C, up, down, up, down. We'll look at that in a minute on the trending moves, okay? Likewise down here, that this circle and this circle right here, these little pokes down through support do not constitute a trend, right? Just like the up move over here that never materialized, you never got this follow through, so that never happened, so you never did get a trend. Similar to that, to the downside, you can see here that we came down with this one spike down here to this fresh swing, breaking the line by a few ticks, kind of sat down here a little bit. If it was going to be a downtrend, what should it have done? Well, it should have come up somewhere perhaps around the midband, which it did. And then if a downtrend was going to ensue, what would it do? It would roll over here and head back down like such. This price action to the downside would then constitute a downtrend, and we would be looking to sell retracements into resistance. Likewise, over here in the uptrend, we are looking to buy pullbacks or retracements into support, and I'll show that in a couple of minutes, right? So the pattern repeats itself. Thrust up, pull back, retrace, find support, up you go. Likewise down here, goes down, now you're in a downtrend, breaks the swing. But you can see here that these 2 things, this one here and this one here, that never happened. This is all hypothetical. Because in reality what really happened was you stayed in the confines of the 3 lines and you were essentially range bound from overnight all the way up until 11 o'clock this morning. Or 11 o'clock. This was your whole trading day right here. This was it. Here's 6:30 right here. Equity markets open right here. Now, back to the issue of consolidation, the term consolidation versus range bound. Those are two very different words that mean different things. When somebody says range bound, okay, let me take these off so it's not confusing. Let me get rid of this one right here. This never happened, and that never happened, and that never happened, right? So a range means that implies that you are in something that is larger than about 10 ticks. So let me show you an example of a consolidation. Going back to what I was showing over here in this yellow patch right here. See this yellow patch? This is probably about 10 or 12 ticks in width. It's yellow bars going sideways, shotgunning around the midband here, 10, 12 ticks in width. This is called consolidation. This is just to be straight up clear about it. This is not tradable. Okay? You shouldn't try to trade this. The reason is that in order to get into trades, most of you know, if you're buying support or selling resistance, you're going to have what's called slippage. Slippage is where you have to get in a little bit ahead or above or below to get in and out. So in the case of this trade, you'd be looking at getting in. Let me take the X off of here so it's not control. Oops, I deleted the wrong one. In other words, to buy the bottom here, you got to fade it a little bit. In order to get in to sell, you got to fade the top a little bit. That's called fading, right? You don't buy and sell right here at the apex of that. You got to go inside of it. That's what the term fade means. Fade means you're coming inside of where the swing is to get in or out. Everybody see these lines? Let me make them a little bit bigger so you can see them a little better. You know, I made the bigger one as default, and it just doesn't accept it. I don't know what's going on there. Okay, and let me go ahead and open this up a little bit so you can really see what I'm talking about. There, is that better? So the meat of the trade is in between these two lines. Now you do have, of course, the slippage to get in and out of a tick, usually at least a tick, right, to get in and out, and you have commission. So you can see that in between these lines, there's just no money to be made here. By the time you get in and out and pay this, have some slippage and commission, there's no meat in there's nothing in here. You can't trade this. This is just simply not tradable. So what I'm saying explicitly and to be clear is that when you see tight consolidative ranges that are 6, 8, 10, 12 ticks, like the top like that, just avoid it. Best thing to go is go look at another instrument, find something else that's moving, or wait till it resolves itself and then trade out of it. Okay, here's another example down here of what I would call sort of shotgun consolidation. Here's a good example down here. See this? See how it just kind of sat down there like that? Just, oops, wrong line. See this? Yeah, this is just not tradable. It really isn't. I mean, the only thing you can do is that if you felt that you had strong support down there is buy the support level as it's sat down here, or buy a pop-up, and then you'd have quick targets here at the mid-band and up here if you wanted to jump in this. What I'm saying is that if you were going to buy this because it was a support level and you were looking to get targets up in here, that's acceptable because that's inside of the range. You wouldn't want to, what I'm saying not tradable, you wouldn't want to get in and out of here trying to scalp within the range. Everybody understand that? Everybody understand the difference of what I'm saying? You're not jumping in and out here scalping multiple times within this. If you were buying support because it was support to get in for an up move, that's acceptable. Question from Michael L. How do you set the midline again? That's part of the VIP dynamic trend. It's built into it. It's just the structure of the bands are built into that. And you know, once you put that on your chart, they will appear as you see right here. All right, now the last thing I want to say about ranges, and then we'll go look at trends, is our threshold for trading a range is generally around 20 to 25 ticks minimum. Oh, this line here, the yellow line, that was this horizontal line here. See this horizontal line? Just pick horizontal line over here and put it on your chart. And then what you do is you put properties, right-click properties. If you want to make it orange or yellow or blue, and you want to make it, this is how you configure your lines. So you want to get all this set up before you start trading. Set it as default, so every time you set it, it looks the same. Okay. So if a market is ranging, and the range overall is about 20 ticks or larger, 20, 25, 30 ticks, that's the lowest threshold, then it's acceptable to trade it, buying support, selling resistance. The other thing that helps is that some instruments are a little better and more clear in how they handle support. In other words, some of them check levels and they respect the levels pretty well. That's going back to the whole issue of your instrument selection. You know, if I put up a YM chart or a NASDAQ chart in this same time frame, exactly the same time frame, it would look completely different than this. So that's why you have to experiment with the different instruments and the different setups and how they respect swings and what have you. All right, so that's how we identify, that's how we see consolidation areas, that's how we decide whether we're going to trade markets, and essentially the takeaway from all of this is that when you draw these lines and your market looks just like this right here in front of you, as long as it stays within the confines of the line, you are in a range. It is that simple. Stays in the lines, you're in a range. Okay? All right, now let's go back over here and look at when the market was trending, okay, and how different that is than our approach to a range-bound market. And I'm going to start with if it's okay, I'm going to go ahead and remove these lines. Does anybody have any questions on ranges and how to look at them? Can I take these lines off? Anybody even need those lines anymore? Okay, I don't see anything. I'm going to take them off. There we go. Clean the chart up. There we go. Okay, good. Now, let me ask this question. On this chart in front of you, where did this market go from sideways to trending up? You can type in a time. So for instance, the times at the bottom you can see here. Here's 9:09, 10:02, you see it, 11:20. Here's the time down here. And here's the levels right here. So you can type in a time and or a level or both. Where on here did we go from, and I know it's a little bit difficult for you because I understand you're not sitting here with me and you can't draw lines on it, which would help you see it. I understand. So I know where you're coming from there. Say, Charles, on all fairness to us, we should be able to draw the line and see. If I could draw the line, I'd see it. Just visually. What do you think? Where did this go from going sideways to now trending up? Where did it actually occur? Either time-wise or swing-wise. I'll give you 10 seconds to answer. This is something you got to be able to see. This price pattern we're going to talk about is something that you want to memorize. Trending or range-bound. And how and when specifically it occurs. Where do you go from sideways to up? I see some good numbers coming in. You got 5 seconds left to answer. 5 seconds. Sideways to up. Time's almost up. Dennis coming in. Jim's got a time. I see quite a few swing levels and times. Those are all looking good, everybody. I know try not to, one of the things we have to know is that don't allow the markets or the charts and all what have you to intimidate you. I know it may be a little daunting when you first look at some of this and you're like, what in the heck am I looking at? But you know what? When you break it down bit by bit, you'll see it's much easier to really understand what's happening than you think. It really is. All right, time's up. Okay, now let's go back and go with our notion of what we discussed here, where we put lines on the chart, and I'm going to help you out. I'm going to put the lines where I would have put the lines, and the lines would have gone more or less here, right? You see this? And I would put a lower line somewhere down in here. Somewhere in here, like this. Now, before we get into the topic of going into the trend, a quick word about putting lines, and I'm going to make it, some of you I know, because I've Skyped with so many traders over the years, I know this is it can be a hairy topic for some of you because there's a tendency to be more sort of a perfectionist. Where exactly is support? Where exactly is resistance? Where am I need to be precise in exactly where I put this line. Think of it this way. Support and resistance are kind of like an area, not an actual number per se. And you want to look for sort of where the preponderance of swings. So if you have several swings that come up, you want to kind of put it somewhere, you know, around where most of them are. All right? Some are going to be a little bit below it, some are going to be right on it, and some are going to be a little bit above it. So you kind of want to split that. Yeah, Diane says that's been a big issue for me as I try to be too perfect about things. Well, yeah, and you know, all due respect, the where that sort of paralyzes you from a trading perspective is that you're taking so much time to figure out where to put the lines, and by the time you eventually settle on where you want to put the lines, because you're trying to say, well, is it here? I just put it there. Oop, that's below it. That's above it. Maybe I should put 3 lines, and then it's all confusing. See, likewise down here at the bottom in this support area right here. You got one here, you got a couple here, you got this little spike, and you got that one right there, a little bit higher. See it? See them all? All right. So you just kind of take a line and you find something that's kind of a compromise in here, and you put the line there. Yeah, Diane, for anyone who is facing that issue, and here, let me dispel another myth for everybody here too, okay? Especially if you're new. You are never, ever, unless it's like winning the lottery, and it does happen occasionally, but it's extremely rare, going to call off and pick off an exact top or an exact bottom. Because in real time, when these markets are moving around, you don't know. You can know after the fact, but you don't know at the time it's really happening. Nobody knows where a market's going, top or bottom. Very, very extremely rare. If you did, think of it like hitting the lottery. You got lucky. So the best thing, if you say that to yourself, speaking to the whole perfectionist issue, what's the best way to do it? What can you do? You can just try to get close, yes? So it's very similar to the support and resistance issue in that way, in the fact that you're never going to have some exact position of support, and you're never going to have an exact position of resistance. The only thing you can do is come close. Come close to it, and then work with that. So back to what we're doing here. Let me show you, where, in my view, where this went from being in a range to going into an uptrend. And I'll break it down like this. I think we all would agree that this thrust took the Russell market out of this range that it had been in for, like, you know, 4 hours. Excuse me, 4 hours in that range, and it broke out. But let me ask you this question. Does this thrust up in and of itself make a trend? No. Everybody knows that, right? We already remember, I'm going back to what we talked about 15 minutes on the other chart, right? A thrust out of a sideways range in and of itself does not constitute a trend. You need more points to connect. And what does that need to be? Well, let's look in the case of here. On this retracement here, the market pulled back into where? Where did the market retrace to when it did this? Almost right to your line where it broke out. Yes? It came right. So here's the principle we are applying here, and I think almost everybody here knows it, but I'll state the obvious. In most cases, not all cases, but in most cases, the theory goes that support becomes resistance, and resistance becomes support. So in this case, it spent 4 hours going in this range, up and down, up and down, up and down, and it finally broke it. And so the bulls are in control in the market. They're trying to take the market higher. Buying programs are stepping in. Traders all over the world are buying the market now. And what causes retracements is profit taking. So anybody who was long from lower levels, wherever they got in and bought the market, are cashing out, just like you do. They're taking some profits. when you have profit taking in an uptrend, it causes a retracement. The retracements normally come into somewhere around where a prior support or resistance level is. We see this pattern repeat itself all the time. This is the pattern you want to try to commit to memory. Try to memorize this pattern, this sort of ABC. Thrust, retracement, holds, and then back up. So the final answer to the question is, if you said anywhere around, say, 1 o'clock Pacific, right midnight to 1 o'clock in the morning, right in here, anywhere in here, midnight to 1 o'clock, overnight on this particular day. This was yesterday, I believe, right, going into today. Anywhere right in here, or any levels around 11:05 to 11:06, anywhere in here, either level-wise or time-wise, then you were correct. In my view, that's where the market went from range-bound into an uptrend. So when we're in an uptrend, what type of trades do we take? Are you buying the market? Are you selling the market? Do you buy the thrust moves? So when a market thrusts up like this, we want to get in. We want to get in up here, right? We buy when it's thrusting. Right when the market's thrusting, we're convinced it's going up. This is an uptrend. We buy the thrust moves, right? Everybody knows that. You buy high, you sell low, right? Isn't that how it works? That's how I do it all the time. Makes a lot of money. No, right, good. You blow out your account. Right. Okay. Now this is a common thing that happens to a lot of traders. So if you're in, if I'm speaking to you, don't worry about it. It's perfectly okay. And let me blow this up and explain what I'm talking about. Here's how this goes. I know the psychology of it. I'm dealing with it for 20 years, so I have a pretty good idea of what it is and how to deal with it. Notice how this market thrusts up here through this swing. So technically, from a technical point of view, when this swing is broken to the upside, you are now in an uptrend. Right here. You could make the case that it occurred down here because this was a higher low and this was a higher high and you had a higher low over here. So, it's always, as it's happening, it's always sometimes tough to see that, right? But certainly by the time this was taken out, there's no question you're in an uptrend, right? So what we do is we are called retracement traders in trends. So in other words, think of it this way. To have a retracement, you have to have what? If you don't have this, then you can't have retracements. What needs to be happening on your chart for you to have a retracement? Begins with a T. Anybody? A pullback is another term for it. Retracement, pullback. Market's retracing, pulling back. You need to have a trend. Without a trend, you don't have a retracement, right? Let's go over here. Let's go back over here. I don't want to confuse things, but let's go back over here to our range, where we had our range, remember? Into the close. Let's go back just very quickly. When you have a market that is going sideways in a range like this, I'm not going to put the lines on here. You remember where they were, right? Line down here, line here in the middle, and a line up here. Can you have retracements in a range? If you're going sideways like this, market looks just like this. Looks that. Can you have retracements? No. You have to have a trend to have a retracement. It's that simple. A retracement is a pullback. It's where traders and software scripts and algorithms all around the world are taking profits in the trend direction. So in the case of this thrust up here, we had several retracements. And I'll try to keep it as simple as possible. Here we came back and we bounced off the midband. So that's a retracement, and we bounced and you got a long trade. Like such. Right? That's a bounce. So in the room, when you hear things like, You know, we've thrust up on the Russell into that 1112 area. We put in a swing up there around 1112 even. You know, it's run up about I don't know, 50, almost 60 ticks. I'm expecting a retracement, and it should pull back in somewhere around the mid band there. I'm thinking about 1109, 1150, 0950. So when you hear those words in the room, it's really important that if you're going to trade that market where those calls are occurring, that you are looking at your chart and the levels that are being called out are ones that you see too. So in other words, when the markets run up here, and it's sitting up here, okay, it's physically, we're in the room, let's pretend we're all in a room, and it's sitting up here, it's thrust, this is the thrust, it's sitting up here currently. And you might hear something like the call might come out, you know, I'm looking for a pullback at least into the mid-band around 0950 or so, looking for a bounce to get long, and then sort of implicitly with that is if you're already long, you can put your stops under there. So in other words, for the traders who got long somewhere down in here or wherever you got in to buy it, there's always a couple of places. I don't want to get too distracted on stops because that's a whole other topic. And when you hear things like loose stops and tight stops, or I give out two numbers, for instance, why do I do that? Well, normally those lines would correspond with the right here. In the case of this move up, this thrust, if you were long from here, anywhere down here, you might hear a tight call. If you had the tight stops, I'd go 1070. And below there, I would put the stops down around the mid-band, a close below 0950. So there's no real sort of mysterious, I don't have some sort of mystical target stop crystal ball that I'm gazing into. You know, it's nothing like that, right? There's no magical mystery thing about it. If you look at your charts, the numbers you're hearing from me are those numbers right there. And I'm actually, if I'm in trades with you and have live capital on the line in the markets, I'm putting my stops here. I'm moving targets and I'm moving stops around. I'm letting things fill and getting in and out and getting in and out. And the numbers I'm calling out are numbers that I'm actually doing on my charts. Okay? So that's what that is. I know some of you might be wondering, what the heck? Why are all these swings? What does this mean? Stops here, bounce there. All right, so what we're anticipating is that after this bounce from here, where it went from this 05-ish area up to almost 12, is a 70 tick move. That's a pretty good move on an instrument. And that after a move like that occurs, we are looking for what? So that's a basic question. In a trending market, after you get the thrust move, what normally comes after it? Here's the thrust move. What comes after a thrust in a trend? We know it's caused by the profit taking from all the buyers who bought at lower levels that are taking profit. When the buyers are taking profit, have what effect on the market? What occurs from the profit taking in an uptrend? Good. Most of you got it. It's a retracement. It's the pullback. It is in the pullbacks that if you are not in the market, let's say for instance you weren't a night owl and you didn't get this move and you're watching it and it's running away. So you have to fight. The first part of it is, and this is the tough part, you have to fight the tendency to want to buy a market when it's heading up like this, up here. You have to fight that tendency. If you have that tendency right now, and here's, I know mentally, psychologically, here's what's going on and how it can physically happen. You see it broke out of the range here, and you watch this thrust up. You make note of the fact that it's starting to pull back into around the mid-band here, and it's just sitting above where that resistance line is, and you're saying to yourself, wow, it's consolidating. You know, this might be a trend change, and we might be starting to head up. This is going through your head while you're watching this, right? Now, it starts to bounce a little bit here, but you're not really still convinced that it's going up yet, not just yet. Because you see this little pullback here, you're saying, you know, it looks like it wants to get support, but I'm just not convinced. I'm not getting in. I'm going to wait. Okay, and so then it starts to bounce, comes up, hits that swing. You're like, wow, look, it's coming up there. Wonder what it's going to do next. Okay, it's kind of consolidating there. Okay, takes it out. Wow, look at this thing is running. Holy cow, this market is taking off. This market's really going. And right about here, what happens? Psychologically, you're convinced by this point right here that it's going up, right? I know it's going up now. I have no question about it. I know this thing's going up. And you know what? I know if I don't jump in right here, I'm going to miss it. A huge next move. This thing's going to blow up 100 ticks. It's going to be the trade of the morning, and I'm going to miss it. And so what do? You get on your chart trader, or you get in your OT, or somehow you pull the trigger and you pull a market order and you get filled right up here, almost near the top, right? So it comes up, it pushes up a couple of more ticks through 11. You're coming up, it's hitting 1190. Maybe you're up a couple of 4, 5, 6 ticks. You're thinking you're feeling pretty good about yourself. This thing's going to run. It's running. I know it's going to run. You're filled. You know, you're up a little bit here, right? By the way, how many does this happen to anybody? Does it happen to anybody? I know some of you do go through this. I know you do. Well, then the market starts pulling back. Now you're underwater. Uh-oh. Oh, no. Oh, maybe I bought the top. Oh, no. Oh, this is horrible. I got filled up here. I was in the green, and now I'm upside down. It gets down to the mid-band, and guess what? Your stops are down here. You're starting to get really nervous. You're upside down by maybe 12, 15 ticks. Maybe you have 2 contracts on. You're upside down by a couple, $300 or more. I better get out. I got to get out. I'm getting out. I got to get out of this trade. I don't know why I do it all the time, but I always seem to buy the top, and then you say things like this. Well, it's all market always knows when I get in because I'm always upside down. As soon as I pull that trigger, the markets know I'm in there, and they pull back, and sure enough, I'm going to stop out. It happens all the time. They know what I'm doing. Wall Street's watching me. And sure enough, you get out down here. As soon as you stop out, what happens? Market bounces and starts to head back up again. Adam, I've never gotten caught in a thrust, not once, not ever. Come on, be honest. Come on, everybody, put your honesty hat on here. We can all let our hair down. We're all part of the Viper team. It happens to everybody. Even expert pro traders occasionally get sucked into what I just described to you, so don't feel bad about it. I plead the fifth. That never happens to me. Yeah, sure, okay. All right. Well, here's the thing. Look, if it happens to you, it's okay. It's okay. It's something that you have to recognize that you're doing, and that perhaps the more important thing is to recognize that you need to do something about it, because it's going to be very, very difficult to make money if you're always getting in at the tops of moves. And markets retrace as they always do. They come in right to your stops area and they bounce. And the fact of the matter is, you should have kept your powder dry, and the buy entry was actually down here, not up here. Okay, that's the second most important thing I want everybody to take away from this, even if you're completely new. So the 2 things we're going to do, 3 things, we're going to put lines on our charts. Yes? Everybody pinky swear that you're going to put lines on your charts at support and resistance. We're not going to be perfectionists about it, right? We're going to find some swings that look pretty good, and we're just going to simply put lines there. Yes? Let's all do it. As long as we remain within the confines of those lines, we are what? In a range. You look at the size of the range, you look at the support and resistance levels, and we make a trading decision whether we're going to trade it. Very simple. Second thing, when markets are in a very tight, let's just say it's 10 or 12 ticks or below, choppy, yellow bars, shotgunning, above the midband, at or near the midband, not tradable. We avoid those. We don't get in the middle and allow them to chop ourselves up. We don't do that. Markets in a range, they have to come up to a swing at the top, and they have to come to a support level at the bottom for us to make a trading decision. Let's all pinky swear we're going to do this. This is really basic stuff, but it's important. When markets come out of their ranges in consolidation, as they always eventually will, you have to quickly determine, has the market broken up, and am I going into an uptrend, or has the market broken support, and now I am in a downtrend? And the third, I lost track, I wasn't counting, or fourth, equally important thing is that we don't get into the trap When a market has moved significantly in a given direction, we have to patiently wait for the market to pull back, retrace is the other word for it, into a support or resistance area to look for trade entry. Everybody got that? I mean, at the heart of our trading methodology, those simple principles, if you will, are essentially the basics, the building blocks, the foundation. Now, the last thing I want to talk about is this notion of a deep retracement, and it's unfortunate I didn't get to talk more about this. I promise you on my next one I'll get more into the details of deep retracements, and you're going to see in a minute. It's hard for anybody to explain a deep retracement to somebody who really maybe doesn't understand what a range and what a trend is. So everybody saw that I had to take the direction I did to get to this point. So when you have markets that are pulling back from swing levels and checking support levels, this is a perfect example right here. Think of it, a healthy way to think of it is, and I'm going to show you several of these before we wrap. There's really three areas to consider when considering a retracement. Some retracements can be rather shallow. In other words, they'll only pull back into a very small, quick, sort of higher level than the mid-band support area. Some retracements, and this is the tricky part of trading retracements and the heart of the matter, some will be sort of mid-range retracements, profit-taking, that will sort of sit and hover at or around the mid-band. The deep retracement comes into play where you go deeper than just the mid-band. And let me draw the box to illustrate that like such. It could go as deep as the outermost band and still be considered an uptrend. Now, I know that's a lot to take on. Here's a simple way to look at it. Simple, just to boil it down. Either the retracement is shallow and it bounces somewhere above the mid-band, up in here. It goes mid-range, right to or out on the mid-band, or the deep retracement can go all the way out to the outermost band. Okay, everybody got that? Now, I'm going to advance this chart, and let's do a handful of retracements together. And I'm going to give you 10 seconds for each one because I'm running out of time here. We're going to go like 5 or 10 seconds, and I'm going to show a series of retracements, and you tell me what you think they are. And we'll do it this way. S for shallow, M for middle, essentially mid-range, mid-band, if you will, right? And D for deep retracement, right? SMD. Okay, here's the first one. Here's a retracement in the uptrend right here. Is this an S, an M, or a D? Shallow, mid, deep. We see the thrust. You only got 10 seconds. You got to type a letter in quick. We're going to do these real quick. I'm going to rip through a whole series of these real quick. 10 seconds. S, M, or D. These are really important. This is the heart of our trading system right here. This whole retracement issue. If you're going to trade and make money in the futures market, you've got to really know this like the back of your hand. Seriously. This whole retracement thing is where the money's at, especially in a trending market. S, M, or D. 3 more seconds. See some last minute coming in. Okay, time's up. It's a mid-band retracement. See it sitting right here? See it sitting right there? It's right on the mid-band. That's a textbook one right there. This is a bread and butter go-to trade. I'll tell you what, I can't guarantee anything. I can say with a very high degree of certainty, that if you learn this one trade and master this one trade using Object Trader, region boxes at the mid-band in trends, you will make money every day. I can't tell you how much. It's how it depends on how much the markets fluctuate and move, and where you get in and how you master that skill. But this would be, if you're going to learn anything first and master it, this would be it right here. Tight consolidation. This is a textbook box. See how it's tight and going sideways and sitting right on that mid-band? So I heard somebody in the live room also made a question of, trade calls. Where's the trade calls? So I want to be clear about this. When Gary or I in the room says, do you see Russell sitting at the mid-band right around that 1050 swing, and it's got a region box, we might not get into that much detail, box that in, bias to the upside. Just to be clear what we're saying take your Object Trader tool, which is the panel over here, you've seen, some of you are using it. Take Object Trader tool, engage the region box, hit your hotkey, get the box up on this can all be done in a matter of seconds, okay? I'm making it a little more complicated than it is. Get the box there, frame the box around the consolidated candles, toggle on long and toggle off shorts, and then hit enter and activate it. That's what that means. All those operations are contained in the words box that in at 1050. That is explicitly what we are saying to do. Use your Object Trader tool, region box it in, long only. Now, the more you come in the room and the more you work with these tools and you learn the terminology and you see all this, it's going to become a lot more clear to you. I mean, it's like anything. It's like you heard this. It's muscle memory. Your brain is a muscle. You have to teach it certain things and has to see the pattern over and over again. And then once you master that skill, we have lots of traders have been with us for years and years and years, and they've been working with these tools. So they know the tool like a carpenter would know how to hit a nail with a hammer kind of thing, right? And if you master the tools and where, equally as importantly, you see where to get in, that's where your money's going to be made, right there. That's where the rubber meets the road. That's it right there. And of course, you bounce, you get filled, you're long, and the market heads up. Good. All right, let's do a couple more, and then I got to wrap. By the way, is there any other questions? Is everybody picking this up? It's making sense to everybody? Everybody seeing what I'm showing here? All right, let's do two more. Yes, good. Okay, David D. Is that helping? Jim W. All right, let's do a couple more, and then we're going to wrap up. Okay, here's trade number 2. S for shallow, M for mid, D for deep. SMD. And I'm referring specifically to this set of bars over here. S, M, or D. These red bars right here. Shallow, S, M, mid-band, middle, if you will, middle retracement, and D for deep. 10 seconds on the clock. Only got two more. This is we're going to do one more trade after this, so see if you can spot what type of retracement we're looking at here. See if you can very quickly start to train your mind's eye to see what's happening in front of you. And once you do that, and you have developed these skills, when the market's going in real time and bouncing all over the place on the chart in your face, you'll say, hey, I see what that is. And of course, you're in the live room, hopefully, with us helping you to see it. That's, of course, why we have the live room, so everybody interacts and everybody's, commenting on similar things. Well, yeah, it's easy to see after the fact, Herman, but the fact of the matter is we do it every single morning for 2 hours in the live room on live charts with real data. I mean, for me to teach this, I have to go back and show what happened because some people are completely new and they don't even know what they're looking at. So we have to do it in retrospect here. But we do it every morning in real time. I mean, we see and call and take these trades every single day in real time. We don't need to see the history chart to tell you what that is. I'm doing this for training purposes. All right, so here's the thing. Here's the thing. It's a deep. Everybody got that right. Everybody said it's a deep. It's a deep retracement, right? So, but there is some question about this, and I want to talk about this because this has come up here. Okay. Can you see? You might have thought that this was a mid-band retracement and boxed it in right here with your region box. I think David D. and there's a couple other. Michael F. said something about this too. Now, if you took your Object Trader tool and you boxed the region in with a bias to the upside, did you get filled? out of this box right here? Were you ever filled long out of that box? No, you never got long. Would you have been filled short with the close of these bars right here? Would you have been short right here? You're short, right? You're short out of the box. Anybody short with me? Short, right? Trend's down. You want to get short. No, you're not filled short. You toggled shorts off. In uptrends, we turn off the short side for this very reason that you see right here. Because at the time that a mid-band box is forming, let me go back and pretend we're looking at this in real time. Okay? Okay, so as this mid-band box is forming and you are drawing it, and we say the words, and you know by looking at it, because it's an uptrend, you know that you're going to toggle off shorts and be long only. So we're looking for a bounce to get long. We want to buy this. And so it has to close above the region box for you to be filled long, yes? The reason we don't put the short side on is because it can do this. It can continue to go down into here. At the time this is happening in real time, we don't know. We think it's going to bounce, and we prepare ourselves for it because that's the proper trade to take. However, it can go below it. And in an uptrend, we generally speaking do not want to get sucked into a short. Because then what inevitably happens is the market finds a bottom down in here and then bounces and starts to go up again. Everybody see that? Everybody see that? Now look, if you're completely new to this and you're just trying to learn like what a futures instrument is, and you're trying to see like just the very basics of a trend and a range, and you're trying to figure out just how do I get in and how do I work these tools, the whole concept of a deep retracement might be, you know, sort of advanced material for you. Let me just put it that way. You don't need to worry about it in the beginning. You should try to learn how to take these. You should learn how to try to take these. Okay, you can use, there's all manner of tools you can take. You can use the line tool, you can use the ray tool. If you're going to use the line and the ray tools, you draw them like such, generally at about a 45-degree angle on a retracement, up or down. The region box, I'm out of time here. There's webinars, there's countless webinars on how, in fact, I did a 2-part series, 2 hours, on how specifically to draw these boxes in detail. In fact, it's called Good Box, Bad Box, Part 1 and 2. All right? I mean, essentially, the easiest way to look at it is this. The tighter the box is and the closer the midband is like your perfect box. And it's got to be a nice solid trend, up or down. This would be a textbook perfect box right here. See how tight that is? See how it's sitting right on the midband? The trend is up and it pulls right back and sits right there. This is like the creme de la creme of region boxes right there. That's it. This is a pretty good one too. It's a little large. Generally your box wants to be under about 10 to 12, 10, 11, 12 tick. If you get a big box that's over that 12 tick level, generally you're in that big consolidation range and you want to stay away from it. Dar, if you take a free trial, this is for everybody in here. If you haven't already done so, sign up for the free trial and you'll get all the links to the live room. Okay? And by the way, if you came from the Ninja webinar, I know many of you did. If you came from the Ninja webinar, we may, I have to talk to Gary. We may open up the room next week. We might do that. Just invite everybody. We got a whole bunch of new people that came from the Ninja webinar, and we may just like do an open house week next week. Come to all the training sessions, all the live room deals. So I'll talk to Gary. We'll maybe try to get that set up for next week. All right, so that's a wrap for me. Any final questions? I didn't really get to cover everything I wanted to, but I wanted to